Gautam Duggad is also joining us this morning. Gautam, let's talk about really, what markets are most concerned with currently, and that's the outlook on earnings growth. How soon do you see that, really improving? Is it still a while away? What's your sense?
Hi, good morning. I think from an earnings point of view, clearly we are in for a long grind ahead, given the weak underlying, economic momentum and various sectors which are facing stress right now. In any case, for FY20, the earnings recovery, or rather the projected earnings recovery, was built on the thesis of banking earnings recovering. Even now, even after the first quarter FY20, where we have cut our Nifty EPS estimates by 4%, and now we have around 13% profit growth estimates for FY20, the fact remains that ex of corporate banks, the Nifty earnings are expected to grow just 3%. So a lot rests on what happens to the banks and what happens to the asset quality and the NCLT cases. If there is a delay in the resolution of NCLT cases, and with the guidance of the various banks from the first quarter earnings season, as well as the ones who attended our 15th annual global conference a fortnight back, there seems to be more cases of stress which are emerging, and that is clouding the outlook for banks' earnings for this year. So to that extent, the earnings recovery, or rather the risk to the earnings downgrade, have become elevated. So that is one point. Secondly, so many other sectors, be it auto, which is a well documented case now, consumption slowdown is here, which is the big takeaway from the first quarter GDP print. So therefore, more sectors are coming and creating more problems for the FY20 earnings. So therefore, to that extent, at 560 rupees of projected earnings for FY20, this number was 585 3 months back, and possibly we can see another 3-4% of downgrade. So essentially, to summarize, we might end up FY20 with similar kind of earnings growth that we have seen in FY19, which was 7%, and similar for FY18 as well, which was 7%. So the hoped for 15% earnings growth for FY20, those hopes are getting dashed in the first half itself.
Gautam, hi there, good morning. Let's talk about the IT space. And this year, it has dealt that painful blow, especially with that tax on the buybacks of shares that was announced in the budget. In terms of the kind of results that the company has delivered in the first quarter, what is it that you're expecting by way of commentary from IT, and where within this space are you finding preference?
So IT, we are positive on it since some time now. I think it remains the most sensible defensive in India right now. Consumer is a defensive, but very exorbitantly priced, and pharma has ceased to be a defensive long back, even though earnings as well as valuations have corrected. So in that context, IT to mind remains one of the best defensives in India. Earnings growth is reasonable at 8-10%, very high quality balance sheets and management, plus 80 to 100% kind of payouts which are happening. From an investor's perspective, it should be immaterial whether you are getting the cash back in the form of dividends or buyback. Obviously some taxation impact will be there, but even then the payout ratios are very high. So therefore we like tier 1 IT right now. Even in the last 3-4 quarters, if you see, the growth differential between the tier 1 and tier 2 has virtually extinguished completely, and that's why you are seeing tier 2 is now trading at a discount. 1 or 2 years back, tier 2 was trading at a premium. The commentaries from the first quarter has been pretty good. Deal sizes, deal wins are pretty solid. You heard about Tech Mahindra, already about $1 billion deal from AT&T which they have got. So clearly IT stands out, and at the margin in the last 20-30 days, you have seen currency depreciation also coming to.
In conversation with Gautam Duggad, Gautam, go ahead. You were talking about the IT space.
Yeah, so the point I was making, Aisha, was that IT remains the most sensible defensive space today in India. Consumer, while being defensive, is very expensive, and pharma, there are issues on predictability. So to that extent, the defensive component has come off, even though valuations have corrected there. So from an IT perspective, you have got 7-8% earnings growth, very top quality balance sheets and management, plus 80 to 90 to 100% kind of a payout ratio. I know that buyback tax arbitrage is gone, but an investor should be indifferent whether it's a dividend or a buyback. So clearly tier 1 remains more preferable for us. The growth differential between tier 1 and tier 2 has come up completely in the last 5-6 quarters, and which is also reflected in the way valuations have behaved within IT. So tier 2 used to be at a premium 2 years back, 1.5 years back. Now it is at a discount. We like Infosys, Tech Mahindra and SCL Tech, and I think that one should have a positive view on IT at this stage, given the way the currency has also behaved in the last 20-30 days, and the overall risk to the earnings thesis for Nifty. IT should do well relatively in this kind of an environment.
Word coming in on IT, but among individual sectors as well, you're seeing consumption and utilities looking attractive. Can you just elaborate a little bit more about where you see opportunity, Gautam?
Yeah, on utilities, clearly the biggest thing which is in their favor right now is interest rates. Interest rates are coming down, and the outlook for interest rate remains very soft. We should not be surprised if there is another 40-50 basis point of cut by RBI. Valuations are at its lowest in a decade, sub 1 time price to book to 1.2 times price to book even for large cap companies. Dividend yields are very attractive over there, 4 to 5%. So we are more positive on utilities than we were a year back or 6 months back, because of the valuation reasons as well as the fact that interest rate environment is in their favor. What we like over there is NTPC as well as Coal India. On consumption, there is clearly a distinct slowdown which is manifested in the numbers that were reported in first quarter. That slowdown is more apparent in discretionary side than on the staple side, because most of the staple companies, they are yet to report volume decline. So there has been a moderation in the pace of volume growth, but there is no volume decline as such over there. Now consumption still remains very expensive despite the time correction that we have seen in many stocks over the last 1 year. But the fact remains that this is a very long-term story over there, and we do not expect the current consumption slowdown phase in the economy to persist forever. So this is a time to actually do stock selection in this space from a next 3 to 5 year perspective. And from that viewpoint, we have been very positive on Titan, Hindustan Lever, Pidilite, Britannia, as well as Marico. And I think this is a very good opportunity for people to accumulate this kind of stocks while knowing fully well that they may not do much over the next couple of quarters because of the way the whole slowdown has played out so far.
Outlook coming in on consumption as well as utilities. What makes you optimistic on Bharti Airtel? While there continues to be a lot of competition within the space, the company is arming themselves with quite a war chest and really trying to take on rival Jio. How much potential or how successful do you think the company will actually be?
So on Bharti Airtel, our view is very simple. We think that ARPUs have bottomed out, and we do expect ARPUs to improve gradually from here. Secondly, from a balance sheet perspective, as you rightly pointed out, they have raised some capital and they are in the process of deleveraging. Plus the announcements from Jio yesterday haven't been so disruptive. That was the fear a couple of weeks back. But given that the lowest ARPU that we are talking about there is 699 or somewhere thereabout, it doesn't seem as disruptive. So and at the same time, their main competitor remains in a big problem as far as balance sheet is concerned. Their debt is quite high. So all of these factors combined with the fact that valuations have also come off and the stock has been absolutely flattish for the last 4 or 5 years, we do believe that it offers a reasonable margin of safety, and if there is a decent pickup that we can see in ARPU over the next couple of quarters, then it also offers a reasonable upside as well.
Thanks so much for sharing with us your top recommendations as well as outlook.